Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine IFRS 9, Financial Instruments. If you are coming across my lecture for the first time, please like the video, share it with others, and subscribe so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you for being part of this channel. So there are three standards on financial instruments. Number one is IAS 32, Financial Instruments Presentation. IAS 32 focuses on measurement and recognition of financial liabilities, including a compound financial instruments. That is, those instruments that have both equity component and liability component. These were covered in IAS 32, Financial Instruments Presentation. So I've told you, if you have watched my earlier video on the topic, I've told you that we used to identify the financial liability by the use of the term issue. We have XYZ Limited issued 10% redeemable preference shares or whatever instrument you have. So the word issue, if you see the word issue, you know it is a financial liability, not an asset, not a financial asset. So then another standard is IFRS 7, which deals with financial instruments disclosure. How financial instruments should be disclosed by the way of note. Then we also have IFRS 9, which is financial instruments. IFRS 9 deals with measurement and recognition of financial assets. It deals with measurement and recognition of financial assets. So, how do you know when the instrument is a financial asset? When you see the word purchase, acquire, invest in. So, when you see any of these terms, you know it is a financial asset. I've told you that IFRS 9 deals with measurement and recognition of financial assets. In accordance with IFRS 9, an entity shall recognize a financial asset on its statement of financial position when the entity becomes party to the contractual provision of the instruments. I repeat, an entity shall recognize a financial asset on its statement of financial position when the entity becomes party to the contractual provision of the instruments. In accordance with IFRS 9, we want to look at the classification of financial assets. Classification of financial assets. Of financial assets. Classification of financial assets. Remember, I've told you that IFRS 9 focuses on financial assets. Now, in accordance with IFRS 9, financial assets can be divided into two. Financial assets. Number one, we have equity instruments. Equity instruments. Number two, we have debt instruments. These are the two classifications of financial assets in accordance with IFRS 9. So I want to start with the number one, which is equity instrument. Equity instrument. Equity instrument is the investment in shares of other entities. Investment in shares of other entities. Purchase of shares of other entities, that is equity instruments. Investment in shares of other entities, that is equity instruments. On the other hand, we have debt instruments. Debt instruments. Debt instruments is the investment in debt instruments of other entities, e.g., investment in bonds or redeemable preference shares. Investment in bonds or redeemable preference shares. So I am starting with number one, which is equity instruments. Equity instruments. Remember, I've told you that equity instruments is the investment in shares of other entities. Equity financial instruments or equity financial assets. Remember, this equity instrument, we are particular about financial assets. Equity financial assets can be measured in two ways. This can be measured in two ways. It can be measured in two ways. Number one, at fair value through profit or loss. Fair value through profit or loss. The FVPL. Fair value through profit or loss. Number two, at fair value through other comprehensive income. At fair value through other comprehensive income. Fair value through other comprehensive income. Of these two, the default is fair value through profit or loss. Fair value through profit or loss. That is the default. What does that mean by default? If the examiner is silent, you should always assume that that investment is always measured at fair value through profit or loss, or where the investment is held for trading purpose. If an investment is measured at fair value through profit or loss, that is to show that the investment is held for trading purpose. The fair value gain or loss of such investment will pass through profit or loss. That is, it will be recorded in the face of statement of profit or loss, not other comprehensive income, because it is assumed that the investment is held for trading purpose. But where the investment is designated at fair value through other comprehensive income, it will be stated in the question. But where the examiner is silent, you should know that it is fair value through profit or loss. Fair value through profit or loss. Fair value through profit or loss. So we want to look at initial recognition. Recognition means incorporating an element into the financial statements. Any item that meets the definition of elements and the recognition criteria. So the process of incorporating them into the financial statement. That is what we mean by recognition. So initial recognition means first time recognition. That is, if you are recording an item for the first time, that financial instruments have not occurred in the past. It is just acquired. The financial asset is just acquired. On the date of acquisition, how should it be recorded? That is what we mean by initial recognition. So when you are recognizing a financial asset for the first time, it should be recognized at fair value. Recognized at fair value. Remember, fair value is synonymous with the market value. So the fair value of the asset at the date it was acquired, the purchase price when it was acquired, that is the amount it should be recorded. Number two, you should take note of this. So if it is recognized as fair value through profit or loss, so transaction costs associated with the purchase of the instrument should be expensed. Transaction cost should be expensed. Transaction cost should be expensed. That is, the transaction cost must not form part of the fair value. You should exclude the transaction cost from the fair value of the instrument, of that financial asset. Exclude it. It should not be included in the fair value of the instrument. So, you charge it as an expense in the statement of profit or loss. Then subsequent recognition. Subsequent recognition. This is not first time now. At the reporting date, how should the financial asset be recognized? At the reporting date, how do we recognize financial assets? Number one, you should remeasure it to the fair value at the year end. Remeasure it to the fair value at the year end. Remeasure that financial asset to the fair value of that financial asset at the end of the year. Number two, any gain or loss attributable to that instrument should be shown in the statement of profit or loss. Gain or loss recognized in the face of the statement of profit or loss. Any gain or gains or losses attributable to the instrument, you should recognize it in the face of the statement of profit or loss, not as other comprehensive income. Remember, we are dealing with fair value through profit or loss. And I've told you, this is the default category. This is what it should always be before it can be considered as fair value through other comprehensive income. I've told you the investment must be a long-term investment. The entity must intend to hold it till maturity. The entity must not intend to sell that investment in a short time. So before you can recognize it as a fair value through other comprehensive income. We are looking at fair value through profit or loss. Then number three, recognize the investment as current asset in the statement of financial position. Such investment should be recognized. Recognize the investment as current asset in the statement of financial position. So where an investment is measured at fair value through profit or loss. I've told you if examiner is silent, you know that investment is always recognized at fair value through profit or loss. Example 1. A company invests in 10,000 shares of a listed company in November 20X7 at a cost of $4.20 per share. At 31st December 20X7, the same shares have a market value of $4.90. Prepare extracts for the statement of profit or loss for the year ended 31st December 20X7 and a statement of financial position as at that date. Now let's have solution to example 1. Solution, that is to example 1. The name of the entity is not stated. So you are to prepare extracts from statement of profit or loss. Now let's have statement of profit or loss extract for the year ended December 31st, 20X7. A company invests in 10,000 shares of a listed company in November 20X7. That is the date in which the investment was made. So we had the initial measurement at a cost of $4.20 per share. So as at November 20X7, let me have workings. Workings, November 20X7. So we have initial recognition or initial measurement. 10,000 shares, and the price as at that date is 4.20. The price as at November 20X7 is 4.20 per share. So how much is the total proceed? 4.20 times 10,000 shares. That gives us $42,000. $42,000. That is the initial recognition. That is the fair value. Fair value of the shares. Fair value of the shares on initial recognition. At the reporting date, which is December 31st, what is the fair value of the same share? At 31st December 2007, the same share have a market value of $4.90. Fair value, that is as at December 31st, 20X7. So the December 31st, 20X7, the fair value of the same investment now will be 10,000 shares times the market price per share of $4.90. That will be 49,000. So if you look at the fair value of the share on initial recognition, which is 42,000, and as at December 20X7, the value has now increased to 49,000. This is leading to a fair value gain of $7,000. The difference between $42,000 and 49,000. That is fair value gain. And remember, this investment is not designated as fair value through CI. The question didn't tell you whether it is fair value through profit or loss or fair value through other comprehensive income. Remember, I've told you that the default category of the equity investment is always at fair value through profit or loss. That means investment is always assumed to have been held for trading purpose. You always assume it is set for trading purpose. It's always at fair value through profit or loss. But where the examiner wants it to be designated at fair value through other comprehensive income, it will be stated in the question. It will be stated in the question. So since you were not being told, the examiner is silent, you should know that this is at the fair value through profit or loss. So that means this fair value gain will be recognized through profit or loss. So you are going to recognize. So we have investment income. On the face of statement of profit or loss, we have investment income of $7,000. That is the extract of the statement of profit or loss. Then go back to the same question. And a statement of financial position as at that date. Now, let's also have statement of financial position extract as at December 31st, 20x7. Now, since the investment is held for trading purpose, that is why the fair value gain was recognized in the statement of profit or loss as income, not other comprehensive income. Take note of that. Now that it is held for trading purpose, that is to show that the moratorium, the maturity of this investment is a year. It's not going to exceed a year. That is always the assumption, that is always held for trading purpose. That is it intended to be realized within 12 months. So that is the implication of that. So if that investment is held for trading purpose, that means it will be recognized as current assets in the statement of financial position. So when you get to statement of financial position under current assets, then you will have equity investment. The fair value at the reporting date, which is December 31st, is the amount that should be recognized. Is the amount that will be recognized in the statement of financial position. How much is the fair value at the reporting date? December 31st, 2007. It's now have a fair value of 49,000. So you have this 49,000 recognized as current asset. That is the solution to example 1. Number 2, we have fair value through other comprehensive income. I've told you the entity must designate the investment as fair value through other comprehensive income before you can apply this category. I've told you the investment must be a long-term investment, not held for trading purpose, not held for trading purpose. 3, the entity must intend to hold the investment till maturity. So when you see any of those features, know that it is fair value through other comprehensive income. Fair value through other comprehensive income. An entity may designate an investment as fair value through other comprehensive income on acquisition. It is on the date of acquisition that the investment must be designated as fair value through other comprehensive income. Once this designation is made, it cannot be changed to fair value through profit or loss. If the investment has been designated as fair value through other comprehensive income, you cannot later change it as fair value through profit or loss. It's not allowed. So we want to look at the initial recognition. So I've told you initial recognition is the first time recognition. So number one, the investment must be recognized at fair value. It must be recognized at fair value on acquisition. Number two, transaction cost must be capitalized. Transaction cost. Transaction costs are capitalized. That is, the transaction cost on acquisition of that investment must be added to the fair value of the investment. It should not be expense. If it is fair value through profit or loss, we said the transaction cost should be expense. But this time around, the transaction cost must form part of the fair value. Remember, if it is fair value through profit or loss, transaction cost must not form part of the fair value. We used to expense it. But this time, it should form part of the fair value. It should be capitalized. Take note of that. Then subsequent recognition. Subsequent recognition. That is at the reporting date. You remember the investment at the fair value. You remember the investment to fair value at the year end. Remember the investment to fair value at the year end. Remember it to fair value at the end of the year. Number two, gain or loss attributable to the investment must be shown in other comprehensive income and taken to investment reserve in equity. Gain or loss. Gain or loss must be shown as other comprehensive income. Other comprehensive income. And taken to investment reserve. And taken to investment reserve in equity. This gain, you are going to take the gains or loss to investment reserve in equity section of the statement of financial position. So these are what you should take note of. Example 2. A company invests in 20,000 shares of a listed company in October 2007 at a cost of $3.80 per share. At 31st December 2007, the shares have a market value of $3.40. The company is not planning on selling these shares in the short term. Since they are not planning to sell it in short term, that is to show that this is a long-term investment. This will never be recognized as a current asset. And the fair value gains on such investment will never be recognized in the face of profit or loss, should be recognized as OCI, other comprehensive income. Selling these shares in the short term, and unless to hold them as fair value through other comprehensive income. Prepare extras from the statement of profit or loss and other comprehensive income for the year ended 31st December 2007 and a statement of financial position as at that date. Now let's have the solution to example 2. Solution to example 2. Now, this investment, let's have the statement. The name of the entity is not equally given. Statement of profit or loss and other comprehensive income extras for the year ended December 31st, 20x7. Remember this example 2, unlike example 1, you were told the company is not planning on selling these shares in the short term and it left to hold them as fair value through other comprehensive income. Even if they didn't add this clause, it left to hold them as fair value through other comprehensive income. See this clause, the company is not planning on selling these shares in the short term. So you should know that the investment will be held to maturity. It will be held at fair value through other comprehensive income. The date of acquisition is October 2007. 20,000 shares were acquired and the price was 3.80. So we have working October 20x7. You have fair value of that investment, which is 20,000 shares, and the price is 3.80. 20,000 times 3.8. So we have $76,000. Then at the reporting date, which is December 31st, 20x7, how much is the fair value? 20,000 shares at what price? Back to the question. At 31st December 20x7, the shares have a market value of 3.40. That means the fair value of that investment will be 20,000 times 3.40. We have 68,000. If you look at the value at the reporting date, is lower than the value at acquisition. Then that means you have a loss. 76,000 minus 68,000. We have 8,000. That is the 8,000 that is loss on investment. This loss on investment, aside the fact that it will be recognized as other comprehensive income on the face of statement of profit or loss and other comprehensive income, the loss on investment must equally be recognized in the equity section of the statement of financial position. So we have fair value loss, that is under other comprehensive income. Now have fair value loss on investment or loss on investment of 8,000. Loss should be subtracted. That is the statement of profit or loss and other comprehensive income extract. Now, let's have the extract of the statement of financial position. So we have statement of financial position as at December 31st, 20x7. Extract. Since the investment is not held for trading purpose, the company is not planning on selling these shares in the short term. That means they'll be held till maturity. Then you will need to recognize this as non-current asset. So we under non-current asset. Non-current current assets. You have equity investment. How much is the fair value of that investment at the reporting date? December 31st, 2007, we have the fair value to be 68,000. 68,000 under non-current assets. Then in the equity section of the statement of financial position, equity, fair value through other comprehensive income, reserve. So you have the 8,000 there as a deficit. So this is the end of the solution to example 2. So I will stop this video here. In my next video, I will examine the debt financial instruments. Please make sure you drop the love emoji. Also subscribe to the channel if you have not done so. Thanks for watching ZICA.